So the new normal spoke to unusually sluggish growth and persistently high unemployment in the Western economies, and that continues, unfortunately, to play out. So today's number tells you that we're still stuck in second gear, even though the U.S. can be driven at a much higher speed. So on the economic front, the new normal still applies. On the markets and front, just remember what you've heard from almost all your guests today, which is our tremendous cross currents. And to go back to something Bill put up on our website yesterday, this is the time where investors should be focusing on singles in a baseball sense and not home runs. Be careful out there. There are a tremendous amount of cross currents, both economic and technical.
Right. Don't get too greedy here in these markets, for sure. Mohamed, I know that Pimco, given this new normal outlook, might be surprised, I don't know, might be surprised at the level of yield that we are here at in Treasuries, a 3% yield. And I know, Alex, you've been watching the movement in the bond market.
Yeah, I have, Betty. And, you know, yesterday we're seeing the yields come off a bit, but overall we've seen some technical patterns of the 10-year yield, sort of a push through some technical levels and then a pullback. We've seen that when it hit 2, 2.5, and 2 3/4, and now we're seeing the same kind of pattern around 3. Peter Cheer of TF Market Advisors says, you know what, he expects a push through 2, 3 1/4 on the 10-year, and even if there's some kind of mini tapering event from the Fed, Treasuries are still estimated to be the first to go.
So, Mohamed, are you surprised that we are even here at these yield levels, given your new normal scenario?
So no, because we were at artificial levels to begin with. So we've always said, be careful, markets are artificially priced, especially the markets where the Fed has been applying its unconventional policies. What I think the market has been telling you is also that we are seeing some significant changes in asset preferences. Some of them are the retail sector, but also look at what's been happening to central bank and emerging markets. They have been using their reserves, so they invest less in U.S. Treasuries.
Right.
So any investor should just be cautious here of all these cross currents, because the economy is telling you one thing, technicals are complicating the matter, and policy is in flux. And that's even before we talk about Syria.
That's right. It's a complicated scenario. I want to just switch over to Europe, because I know, Mohamed, you've been cautious as well on what's been going on in Europe. And Julie has been looking at how the European markets have been trading.
Well, you know, Pimco and Mohamed have been increasingly in the minority when it comes to the caution on Europe, at least if you look at what we have seen happening with European assets from the European stocks, or the Euro Stocks 50, which is the benchmark for the region, the 40% recovery that we have seen since the lows, and the depths of the concerns about a fiscal crisis and a potential breakup of the region at that point. You can also look at Italian bonds. That's another indicator. Yields there, of course, have stabilized around 4.5% at this point. Not the lowest that they've been over the past 3 years, but close to those levels. Again, expressing less worry or increased confidence, depending on how you want to look at it, as to the plight of the euro region. And then finally, if you look at the euro itself, just not reflecting that concern about a breakup anymore. For the year to date, we have seen stabilization in the euro, to say the least. Also, if you look at correlation, Betty, between the euro and other types of risk assets, particularly in the emerging markets, you're seeing a lot of money flow from the emerging markets into the eurozone and into the euro itself as the economy there does stabilize.
Well, Mohamed, so are investors in Europe too optimistic then about the recovery?
I think everything that's just been said is absolutely correct. The question we analyze in our investment committee and with our European colleagues is, are the reasons behind this permanent, or are they temporary and reversible? And we get a sense that this summer of tranquility in Europe has been due to quite a few factors that are temporary, including postponing every difficult decision beyond the German election. So we would say, you know what, and we have, in terms of our positioning, we thought that peripheral bonds had sold off too much and we had increased our positions. Now we've reduced them because we believe that this tranquility is partly due to temporary and reversible factors, and therefore let's take some money off the table, which we have done.